ladies and gentlemen, our first NatCon session is on global and Indian macroeconomic trends. And before I call him on stage, allow me to introduce our speaker, Mr. Neelkanth Mishra. Mr. Neelkanth is the chief economist at Axis Bank, as most of you know. He is also the head of global research and a whole-time director of Axis Capital, a highly respected expert on global and Indian macroeconomic trends. He joined Axis Bank in May 2023 after a very long and distinguished two-decade stint at Credit Suisse. He is also a part-time member of the Indian Prime Minister's Economic Advisory Council, as well as a part-time chairman of Aadhaar. He has also advised government bodies like the India Semiconductor Mission and the 15th and 16th Finance Commission. He is a gold medalist and distinguished alumnus awardee from IIT Kanpur and was ranked 4th in the entrance exam to IIT, which should capture every Indian's dream. What a dream resume this is. Please join me in welcoming him with a very warm round of applause. Ladies and gentlemen, Mr. Neelkanth Mishra.
Thank you. Good afternoon, everyone. Thank you, Bowman, for inviting me. Thank you, CREDAI, for this opportunity to address such an august audience. As I go through the slides I have, you will realize why, when Bowman asked, one, of course, I mean, he's a good friend, I know him well, but also how important real estate is for the economy. A lot of the discussion today that I've heard so far is about real estate benefiting from India's economic growth. What I would like to show you is how important real estate is for India's economic growth. And one of the reasons we slowed down was because the real estate sector had slowed down. So I'll start with about a 10-12 minute overview of where we are in the world. The global economy does not directly affect us, but it does have an impact on overall sentiment. I will then focus on what's driving India's economy, and there we'll spend some time on real estate. And towards the end, I will also highlight some of the risks that exist. In our ebullience, in our desire to become developed, we sometimes can throw care to the winds. I think it's very important to be very cautious and conscious of all the risks that lie ahead of us. So this is where we are. If the charts can be presented here, I think the audience here can see it as well. Yeah, there it is. So you can see that every economy, other than the US, is actually doing very badly after COVID. What we have plotted on the right is where we are versus the pre-pandemic path. So there was a certain trajectory for the economies before the pandemic, and post-pandemic, most economies are growing slower and are lagging behind. So you can see globally, we are about 4.5% below where we were supposed to be. Given that the global economy was growing at about 3.5%, 4%, that's like 1.3 years of growth lost. You can see for China, the slippage, this is the red column here, is about 6%. So China continues to slip. The growth post-pandemic is significantly lower than what they were seeing pre-pandemic. There's only one economy, which is the US, which is the gray column here, which is actually ahead of where it was supposed to be. And there is a reason for that, which we will discuss later in the charts on why they are ahead and why there is a risk to that. So the global environment from a growth perspective does not look very attractive. Let's come to China, because China was and still is a very major part of global growth. In the previous decade, it was given, take any year, 35 to 40% of incremental global growth. So how fast China grows is very, very important for the world and to a large extent for us also. Now, what you see on the left is the reason why the Chinese are in trouble. In any economy, GDP is what? GDP is activity. GDP is about incomes. You can generate income by consuming. So when we book this hall, we book the hotels, we are generating income for the Aussies. We also generate activity and incomes when we build, when we invest. Now, if you only have consumption, but you don't have investment, there is a problem because there is not enough capacity. So beyond a point, it becomes problematic for the economy if there are not enough hotels, if there are not enough offices, if there are not enough houses to live in. Similarly, if you overinvest, if you only have factories, if you only have houses, empty houses, but there is no one living in them, that becomes a problem. And I think the Chinese overinvestment has become a very serious issue for the Chinese economy itself. So you can see that the green part, which is household consumption, has become 40% of GDP. Now, this is never happened in history. In India, it is more like 60-65%. In the US, it's 80%. Perhaps it's too high. But sustaining an economy where 40-45% of your GDP is coming from just building factories or houses is something which is absolutely unsustainable. So the problems were supposed to have started at some point. They seem to be hitting us now. And I'll run you through some slides to explain why this is happening now. What you see on the right is what we call the incremental capital output ratio. So basically, how many dollars of capital do you need to generate $1 of income? And what you can see on the right is that Chinese investments, in order to generate $1 of income, they need to keep investing higher and higher. Real estate was a very important part of the Chinese growth story. If you look back about 25 years, it started off when around the same time that India was also doing the same thing. I grew up in a town called Bokaro. My father, sale was his only job. He also got this small 2 BHK where I grew up, where it was given on a 33-year lease to him. Around the same time, the Chinese SOEs, the state-owned enterprises, had also been given the authority to transfer these houses to their employees. You won't believe it. In 2003, when these were transferred, the value difference, so there was a market value and there was a price at which they were transferred, it was 1/3 of GDP. That was the quantum of wealth transferred from the state to the citizens. And around the same time, they completely freed up the real estate construction market. What resulted was the mother of all booms. In fact, most people think that the Chinese economy is driven by exports, that exports are very important. I'm not saying they're not, but Chinese goods surplus, even today, is actually only about $1 trillion. They are nearly a $20 trillion economy. A large part of what their income has been generated by is the construction of houses. So real estate was a very integral part of the Chinese growth story. And as it starts to slow down, what you're seeing here is that the sales volume in million square feet, you can see in 2017, it was 80 million square feet a quarter, now monthly, and now it has fallen to less than 40. So the sector is going through a very, very severe recession. You can see the prices have started to fall. So tier 1, tier 2, tier 3 or below cities. For a long time, people thought that just renewing housing would actually also suffice, in the sense that if you had really old houses, replacing them means that you destroy the old, create new. The creation of new actually creates income. Now what you see is that a very large percentage of houses actually have been built only in the last 25, 30 years. So it does not make sense for the houses to be broken down and rebuilt again. So the renovation side has also been fully exhausted. While there are cities like Shanghai and Beijing, Guangdong, in the Guangdong province, where perhaps the markets are still resilient, but remember that 80%, if you see the pie chart here, 80% of the square footage, the square meters in China is in tier 3 cities. And there, the population itself is shrinking. So as you know, Chinese population is starting to shrink. Normally, as it happens, it starts to shrink at the periphery. What you are now seeing in China is that while Beijing and Shanghai may see some growth, the cities outside that are seeing massive shrinkage. And 80% of the square meters, and this actually holds true for us as well, as we think about our real estate markets, we need to think beyond the top 10 cities, because if the real growth has to happen, it has to happen in the top 500 or 1,000 cities of India, not just the top 10, 15 cities. What the Chinese did when the real estate sector had to be de-emphasized, when Xi Jinping very famously said, houses are for living, not for speculation, and there were so many empty houses being built. So the Chinese banking system started to move investments away from real estate towards industrial capacity. So what you see on the left, if you see the gray line, that is loans to real estate, and they are now starting to fall year on year. All of these savings, but the banks still had deposits. What do they do with them? They started to give it for industrial capacity. So what you see on the right is that the share of loans to industry started to rise rapidly. You can see the maroon line. It's now almost 20% of all loans are just for industry. Now, just to give you a sense of scale, between March 20 and March 2024, the incremental loans to industry in China were $1.9 trillion. For perspective, all of our banking system, all banks put together, the cumulative loan book is $2 trillion. Just incremental loans in 4 years to industry in China was $1.9 trillion. This is, and as I will explain later, a very major risk for our growth as well. So the Chinese have so far not slowed down, but what is starting to happen now is that the world cannot take so much of capacity. So what you see on the left is that incrementally, the returns on industrial capacity have also started to slow. So now there is no need to build more battery plants. There is no need to build more electric vehicle plants. Just to give you a sense of scale, China today can make 50 million cars, 50. Its domestic demand is about 27, 28. Global demand is around 80. So they can make, if they want to, 60% of the world's cars. So beyond this, why would you want to add capacity? So what is starting to happen is that if you see the right-hand side chart, these are the returns on these investments. So the gray is the SOEs, the state-owned, so the government plants were, of course, generating low returns. Now the private sector plants are also starting to generate low returns. And therefore, the Chinese, if you look back at what I've just discussed, real estate was a very integral part of their growth. Then real estate started to slow. That money initially for the first 3-4 years was put into industrial capacity. Now we are realizing that even the industry cannot absorb that much capacity or that much capital. And therefore, the Chinese growth is suddenly starting to slow very rapidly. Can consumption revive? Can they give more consumption loans? That is where things become really problematic. Because a lot of Chinese government funding used to come from land sales and therefore was very integral to real estate, and therefore real estate was very integral to that, the government funding or the resources that the government gets have also shrunk. Now, what that means is if you see the left-hand side chart, what we have plotted on the x-axis is the median age, and the y-axis is the public health as a percentage of GDP. China has a very underfunded healthcare system. So as you have an aging economy where a large part of household wealth is stuck in real estate, and what you have is a state which is seeing shrinking resources, there is no way that it can spend more on healthcare or on pension assets. So if you are a 50-year-old in China, what are you going to do? You're going to reduce consumption. And therefore, the Chinese economy is in a, I would say, a downward spiral. And beyond a certain, maybe a 2-3% growth, I don't think they'll be able to sustain it. So this is extremely important for us because what this also means is goods deflation. China was creating excessive demand for metals, for various types of materials, energy. I think all of those will be growing, the demand, global demand for those will be growing much slower than what we've been used to. Where are we with the US? As I said, the US was doing very well. The US consumption growth, you can see on the left-hand side chart, has post-COVID done remarkably well compared to the rest of the world where consumption growth has been a bit weak, except for India. The US consumer has actually held up. But what is now starting to happen, and I'll explain to you why, the right-hand side chart, the real disposable income. So basically, the economy is starting to slow, income generation is starting to slow, and more importantly, the job openings are becoming fewer. So what you can see, the vacancy to unemployment ratio, which is a very strong indicator of how good the job market is starting to decline. You can see the wage growth is starting to fall, which is the right-hand side chart. And going forward, things in our view are going to get worse. See, the US in the 2008 to 2020 era had adopted what we call tight fiscal, loose monetary policy. So when you're trying to manage economic cycles, see, sometimes you'll see the economy is slowing down and the government needs to do something. The economy is doing a lot, interest rates start going up, the government starts to bring down fiscal deficit and all that. So there are fiscal and monetary tools available to smoothen the economic cycles. Now, after 2008, the US adopted a tight fiscal policy. They had spent a lot of money recapitalizing the banks, and they started to cut interest rates. So interest rates went to zero. They started doing quantitative easing. The government started to, the central bank started to pump a lot of money into the economy. So the global cost of capital actually came down. This did not work. I was talking to some people in the Biden administration, and they said that it took 7 years for unemployment to normalize, inequality went up sharply. This was not a policy that did very well for us. So in 2020, and this is the wonderful thing about Americans, they're very pragmatic. There is no dogma in terms of what school of thinking you are following. If it doesn't work, change something. So they changed it. In 2020, they decided to do loose fiscal, tight monetary policy. Actually, tight monetary came later, but they decided to keep a very loose fiscal policy. So the government started to spend a lot. Now, just in the previous fiscal year, FY23, their fiscal deficit went from $1 trillion to $2 trillion. Can you imagine? 1 trillion to 2 trillion in a $28, $29 trillion economy. Sharp expansion in fiscal deficit. And whenever fiscal deficit goes up, the economic momentum picks up. The problem with this type of growth is that it's almost like addiction. So you get addicted to a certain dose, you need to get a stronger dose to get a high. Now, and of course, you can't keep raising your fiscal deficit forever, so now the government is starting to reduce its fiscal deficit. So what you see now on the left is that incrementally, the government in the US is bringing down its fiscal deficit. It needs to bring it down even more. And what that will mean, and so this is the reason why these charts that I showed you are so important, that as the government's fiscal impulse, or the fiscal stimulus has started to first flatten and then reduce, the economy is slowly starting to slow down. And therefore, I won't be surprised if sometime in the next 9 to 12 months, we start to see a US recession. So the US, which has so far held the global demand up, is also, I think, likely to be in some trouble. The last thing here, when the US was doing or adopting a tight fiscal, loose monetary policy, global cost of capital had come down. Global cost of capital had fallen to very low levels. When the US adopts a loose fiscal, tight monetary policy, the global cost of capital goes up. So even if the Federal Reserve was to cut its rates very sharply, the effective cost of borrowing globally will not come down. The effective cost of borrowing is the yield on the US government bond. The yield on the US government bond, in my view, is not going to come down much more from where we are unless the US gets into a recession. So this is extremely important. What the US is trying to do is something which I find fairly dangerous as well, in the sense that it is trying to manage its borrowing by keeping it short term. Imagine, and this is something that all of you will understand and appreciate. that if you need some funding, would you take 3-month funding or a 5-year funding, right? And what the government is doing, if you see the right-hand side chart, that the largest borrower in the world, which borrows $2 trillion a year on a net basis and 3.5 to 4 trillion on a gross basis, is borrowing 20% of, actually 80% of its borrowing in the last 1 year has been in the less than 1 year period. You can imagine the kind of liquidity risk that the US federal government is taking. Of course, elections are coming, I think they're desperate, but these are all big risks for the economy. What's happening to India? What you see on the left is the consensus expectations for GDP growth. And you can see they have been steadily getting revised up. So from Jan 23 to around, I would say, April, May of this year, the FY24, FY25 GDP growth estimates were being revised steadily upwards. The question is, are we done with these upgrades? Are we now going to see downgrades? And those are the questions that I will try to answer in the next 15 minutes or so. So the first thing to keep in mind is that on a 5-year CAGR basis, right? So if you take the average growth over 5 years, CAGR is cumulative annualized growth rate. What you see on the right is that we have rarely grown above 8%. This is all in real terms. So we have kind of reached the 7.5% range several times, but we have rarely grown beyond 8%. And my sense is that as we think about the next 5 years, assuming a 7% kind of real growth is the best outcome. And the reason is that in any economy, growth comes from 3 major factors. The first is labor input, the second is capital input, and the third is total factor productivity. I'll explain to you what that means. So if, say, in my research team, I want to increase output, I can add more research team members, that is labor input. I can give them access to better databases, artificial intelligence tools. These are very, very powerful these days, which will be capital input because I'll pay money for that. Or I can get them to work smarter and faster by getting them to collaborate better and all that. That would be total factor productivity. So in India, in the next 5 years, labor input should be growing at about, I would say, 1% a year. 1.1 is our forecast. Total factor productivity in India, and I'll show you the charts, is growing at among the fastest rates in the world. And there are many, many reasons for that. We have finally learned how to build highways. Our railway capacity is going up. We have electricity in every household. We have piped water going in every household. We have pakka houses everywhere. The government is appointing people like me into important positions, meaning that the distrust of the private sector is gone. See, compared to 20 years back, or even 5 years back, I wouldn't have imagined that a bank employee, an Axis Bank employee could be the chairman of Aadhaar, or the SEBI chairperson could be someone with a private sector background. So there are many new changes that are starting to happen. I think the state is beginning to trust the private sector, and that I think is a very, very important driver of productivity as well. So we should see fairly strong productivity growth, and we are seeing very strong labor input growth. What happens to capital input? What you see on the right is GFCF stands for investments, gross fixed capital formation. GFCF as a percentage of GDP, you can see in 2012 was 34%. It had fallen to 21%. So a very important reason for the economy's slowdown between 2012 and 2021 was the slowdown in capital formation. I'll come back to this chart. This gives you a longer history. So what you see on the left is, again, the same split. So you see that between 1980 and 1984, while our economy grew at 5.5%, labor input was growing at 3%. That, of course, cannot grow that fast currently, I mean, in the next 5 years, because our population growth is not growing at that level. But it makes the GDP quality much better. And as we think about housing, as we think about the quality expectations of people, and I'll focus a bit on that as well, it is very important to understand that the nature of growth, being labor-driven, So, for example, GDP till say 200 years back or 300 years back would only grow because of growth in population. But in that case, the quality of life does not change. So the per capita GDP is where you start to see behavioral changes happening, where per capita earnings are going up. So as people say that when you go from $2,500, $3,000 per capita to say $9,000 per capita, your car ownership goes from 10% to 90%. So many such changes start to happen. Growth we call fun growth. But you see on the right, the reason why growth started to slow, the gray line, was because capital formation had started to slow. Why did capital formation start to slow? See the left-hand side. The GFCF to GDP ratio fell by about 7 percentage points between 2012 and 2022. 5% of that happened because of real estate. The real estate downturn, in my view, was the reason why the economy had slowed down. So household investment in dwellings fell by 5% of GDP. Of the 3.5%, the fall in machinery investments as a percentage of GDP, a very large part came from manufacturing, and manufacturing also was mostly in metals, in cement, in machinery. We have this detailed report where we demonstrate that cement volume growth and steel volume growth grow 3 to 5 percentage points higher when the real estate upturn is happening. And when the real estate downturn happens, the demand for these sectors also starts to come down. So if I was to, this is part of a report we did for Niti Aayog, where they wanted to understand what are India's capex prospects. And these are the only two conclusions we gave, that the GDP slowdown, the investment slowdown had happened because the real estate sector had slowed and because we had excess capacity in power. Now, both of these are now starting to turn. The real estate sector in particular, if you see the left-hand side chart, in the last decade or so, there has been about a 2.4% a year increase in the number of households. See, population growth has slowed to 1%, or less than 1%, 0.8% now. But the size of a household keeps shrinking. So what you see now is that the number of households is growing at about 2.4% a year. In urban areas, because urbanization is rising, the growth is more like 3.2, 3.3% a year. What you're also seeing is that the square footage per person is expanding. In India, you have about 100 square foot per person. In 2019, the average Indian house was about 460 square feet. This includes rural houses and all that. In China, in tier 3 cities, the average built-up area per person is 550 square feet. In the US, it is 700 square feet. And in the US, it is still growing at 1% a year. So as incomes grow, and that is why I emphasize that per capita GDP, as you grow bigger, as you grow richer, you start feeling better about yourself, you start demanding better houses, or bigger houses. And you start demanding better houses. So what you see is that the square feet of construction, the cost of construction per square foot is night and day different between building a rural house and building even a 5-story apartment in a city. So therefore, the value of construction needs to rise really rapidly. The reason why that didn't happen was because real estate prices had risen too sharply. So what you see on the left here is that real estate prices, because of supply constraints, because between 2007 and 12, Indian cities did not give fast enough approvals, the supply of real estate was not strong enough, and therefore the housing supply didn't happen, and prices went up very sharply. They went up so high that then there had to be a significant amount of time correction. So what you see on the right, the gray columns, and of course this is your data, for nearly a decade in the top 8 cities, the square footage sold was flat, about 150 million square feet a quarter. But as you can see, the per capita GDP started to shoot above so the time correction in real estate prices happened, what you see is that the demand has suddenly started to go up. And I think when these cycles turn, they tend to last a while. Of course, I'll be educated from the leaders here. But this is, I think, the most important reason why I think India's GDP is in good shape, that the real estate cycle has turned. So while most of the presentations so far I heard were about how real estate tends to benefit from India's GDP growth, my take is totally the opposite. It is because real estate is turning and that prices are at a level which are affordable, that demand for housing is picking up. As per capita GDP improves, people want bigger houses, better built houses, and therefore the GDP growth will start to pick up. Demand for steel, demand for cement, everything starts to improve. Which is why, in addition to the demand, better demand for power, because in power as well, we are now starting to run out of capacity. We have not built enough power capacity for the last 7-8 years, and therefore now we need to add to capacity. And therefore, we think that investment to GDP ratio is likely to pick up from here. A second point I wanted to make is about our services exports. One of the biggest problems for the developed world today is supply of people. And what has also happened over the last 30-35 years, I would say in particular in the last 10 years it has accelerated, is that the cost of service provision cross-border has come down quite sharply. So cross-border telecom capacity is rising at about 25-30% a year. The amount of bandwidth that you can have when you are communicating cross-border is now significantly higher than it used to be. On a I would say price-adjusted basis, the price of I would say transoceanic travel is down by 90% in the last 50 years. So it's much easier and cheaper now to travel cross-border than it used to be, say, even 10, 15, 20 years back. And what this means is that the services industry is rising very rapidly. And this means that India's services exports, partly because of what we've achieved in IT, but also because now business services exports, car design, aircraft design, semiconductor design, increasing numbers are starting to happen in India. So India's global share of services exports has now reached 8%, and I think it will continue to rise. What this means is, of course, greater demand for global capability centers, significant demand for office space, and for all the high-income people. Like, there are consulting firms which provide services from India whose per capita payouts are like 25 lakhs a year. And so therefore the quality of houses they would want to live in, the amount of expenditure they will make in malls, in restaurants, is going to be that much higher. So I think this is another, in addition to the revival in real estate and the revival in power capacity, this is something that keeps me very excited because this is a very steady growth that I expect going forward. Now I'll quickly run through some of the headwinds. The first is that India's fiscal deficit is coming down, but it needs to come down more. Sovereign debt to GDP is very high. Compared to what the world is doing, of course, we are doing much better. But this means that if there was another downturn, the government of India does not have the capability to re-stimulate because the fiscal space is not there. The second is that at this stage of economic growth, you are bound to see a growth in inequality. So you look at any economic theory globally, at this phase of growth, for the next 20 years, labor will be in surplus, capital will be in shortage. And when this happens, capital share of income goes up, the rich become richer, the poor don't grow that fast. I mean, they'll also see an improvement, but not fast enough. Now, when this happens, you can see how weak, despite the economic recovery, staples like FMCG products, the sales growth is not picking up. And I don't think it will. Meaning, I hope it does well, but I don't expect it to. But and so what states are now responding with, you can see on the right-hand side chart that now 12 Indian states, when we did this chart it was only 10, 12 Indian states now have income transfer schemes. Nearly 20% of Indian women, adult women, now get monthly transfers from state governments. So politicians are starting to respond to this, but I think our challenge is going to be that we are what they call a precocious democracy. When other countries went through our phase of development, they were not fully functional democracies. Japan did not have universal franchise till 1924. The Brits didn't have universal franchise till the First World War. Korea, Taiwan were dictatorships when they went through this phase. China, of course, doesn't need to bother about people's opinions. So we have a very unique challenge, and I think this is a political risk that we need to be cognizant of. Monetary conditions are very tight. In fact, I wanted to show you this chart, which I skipped through at that time. See, currently the economy is slowing down, and I don't know if you have seen this, but June and September quarter sales have been pretty bad even for real estate. I expect this to be temporary. What you've seen is RBI, I think, unduly tightening monetary policy, and the fiscal contraction has been quite extreme because of elections. But I expect this to turn around. I expect that fiscal spending by the government will turn around, and I think RBI has already, let me come back to the chart. So you can see on the right that the RBI is keeping overnight liquidity in surplus, and therefore I think their signal is that they will ease liquidity going forward. We are also a very unique major economy in the sense that we don't own any dense forms of energy. So 50% of our dense energy is imported. So whenever there is a global disruption in energy prices, it becomes a huge headwind for us. So right now it's in our favor. Oil prices are at 74, 75. Coal prices are in control. We are fine. Chinese are bringing down solar panel prices, which is even better. But this remains a vulnerability. So this is not in our control, and therefore we need to be cognizant of it. The fifth is what I mentioned earlier, that I think the US adopting a loose fiscal, tight monetary policy means that the cost of capital globally will remain elevated. The US has a fiscal headwind. I mean, it's a huge fiscal problem. I think US 10-year bond yields will not fall unless the US goes into recession, and which I think is a huge problem for us as well. So capital inflows as a percentage of GDP will remain a problem for us. What you also see is that global demand is going to be weaker than it was when China was going through this phase. As you know, China was at our per capita GDP in 2006-07. But at that time, global economy was growing at 4.5%, 5%, partly, of course, because China itself was accelerating. We are not that large right now to drive global GDP. If global GDP is 1.5% slower, our overall growth will also be slower. So there is less of an opportunity. And the biggest problem is China itself. So China has now created so much surplus capacity that it is shutting off several aspects that we could have used for our growth. So the reason I spend so much time in China is that all the industrial capacity that they're setting up, I mean, can be good use to us, right? I mean, when we take in inputs from them. But that means that domestic manufacturers will not see that demand. Last point, and I was asked to keep this so that at least this topic is covered. I think the rupee is likely to remain very stable for those of you who see global funding or dependent on it. The RBI has now close to $700 billion in reserves. If the rupee has to depreciate, it will depreciate gradually, so the volatility will be suppressed. The rupee has been among the most stable currencies in the world. So you can see it has been less volatile than even the Chinese yuan, which is we all know is a managed currency. So I think that should persist. So I've taken about 5 minutes more than I intended to. There are still 7 minutes left. So if there are any questions, I can take them. Thank you. There was a question there. Are there mics in the audience?
Oh, okay.
Yeah, internally there. So this has been used.
No, at all.
Did they connect?
Yes, so the question is that the growth rate in household formation seems to have slowed. See, this is 2011 to 24. This is also an approximation because the census has not been done. This is, I think, also a reflection of the fact that in 2011-12, our urbanization process slowed down because we couldn't manage the cost of housing, we couldn't manage the infrastructure well enough, and therefore the process of urbanization also slowed down. If we can expect that because of what we are seeing in Mumbai, what we are seeing in Bangalore, in Odisha, in Bhubaneswar, lots of fascinating amount of urban infra starting to get built, growth should be better. But remember that our total population growth itself is now slowing. So we have now crossed the threshold at which population can be sustainable in the sense that the fertility rate is now less than 2.1. Population will start shrinking after 2055, so that's not something to worry about. But if the population growth today is say 0.6, 0.7, 0.8%, I don't think the number of households can grow really beyond 2.4, 2.5. So I don't expect it to decline if you're thinking about the next 5 years.
Hi, I'm Subhakar Rao from Champion Lagoons. One quick question. I was talking to Irfanji just a minute ago about the fact that Indian real estate builders are doing some real iconic projects now, but I still see a significant chunk of Indian investments going to other countries into real estate, like they're buying in Dubai or they're buying in other countries. Do you have a quantum of what kind of amounts is going out of the country and what can be done potentially to, I guess, retain more of it in the country? We have phenomenal developers here.
So, so the question is, there is so much investment going to Dubai and other places, can we not retain it in India? I think definitely we should try to. So in terms of quantum, see, while for the markets that most people in this room would see, that is maybe sizable. But when I think about it at a macro level, because whatever money is going out of India is being tracked. At least whatever is going out of it officially is being tracked. And that number is not more than $15, $16 billion. So it is not, that is a total outgo under these various schemes that are allowed. Most of it, I mean a large part of it would also be for education and other expenditure. If I put everything together, maybe it won't be more than $8, $10 billion. Now if I think about commercial and residential real estate as what I call the gross value of output as a percentage of GDP, it used to be 16.5% at the peak. At the bottom, it was 10.5%. Now it is about 12%. In a $4 trillion economy, it's about $480 billion is the total value of construction on an annual basis. So it will affect 2-3%. Maybe it will affect the premium segment by 10-15%. The only way to address that would be through very different types of measures, meaning that you bring down the peak income tax rate. I know a lot of people who are moving out because 39-43% income tax rates. And now with the financial sector, like, the world over, there's a big inflow into Dubai. I think those kind of things are hard to reverse. So some I think you'll have to live with. Just like, if you go to Melbourne or Sydney, I've been to apartments where the instruction booklet is in Chinese. So when you grow richer, as a certain percentage of the households will want to diversify geographically. Some I think is also very hard to avoid. Sure. There was a question there from the lady. Sure. I can hear you.
Scheduled, I suppose, for very short recurring cycles, which is factored in by the markets. And the trend of de-dollarization is definitely there. So like, as you said, dollar was also a definite source of investment and income. Now, what does the de-dollarization and the plummeting of dollar, which is definitely going to happen with your 200 BPS cut, what does it bode for Indian rupee? And if so, what does it bode for our industry?
No, thank you. So now that's a very important question. So if the Fed keeps cutting rates, how does it, or the trade-weighted dollar change, and what does it do to the USD INR? So I think the trade-weighted dollar for sure is likely to depreciate. I think that much seems to be a given now. A lot depends on what the alternatives are. So it's not that the Europeans are in any great shape. They're also struggling. The engine of the European economy, which is Germany, the total output is down 26% from the peak, and it doesn't seem to be improving. So other than maybe Spain and a few other pockets of strength, Europe is also in deep trouble. The question is, what does it happen? What is the USD INR that we should gun for? And this is where you have to move beyond theory and get into practice. My sense is the RBI will not let the rupee appreciate. So what you will see is maybe a controlled pace of depreciation. Remember that our manufacturing is competing with China. If, say, Mr. Trump comes to power, he imposes a 15%, 20%, or 50% duties on Chinese imports. They're already shutting down Chinese car components and all of that. It is quite possible that China does a one-shot 20% devaluation of the currency. Now, we do not want to be in that sorry state where you allowed the currency to appreciate, and then suddenly you say, oh God, China is now devalued by 20%, and so let's start chasing them. Because we want to keep the rupee stable. And if I was what I'm forecasting, what I'm expecting is maybe a slower pace of devaluation against the dollar, but not an appreciation. I don't think we will cross 80 on the upside.
Hi.
One last question, I guess, because I'm told I'm out of time.
Yeah, I have two last questions.
Sure. Okay.
Fantastic presentation to begin with. I have two questions. One is, through this economic cycle that India sees for the next 5, 10, 20 years, what sort of commodity pricing can we expect for Indian real estate? And the second part of the question is, do we see non-Indians buying Indian real estate? Do you think that's a foreseeable future?
Okay, the second one is really interesting. I'll come to that. The first one, which is why I spent so much time on China. I mean, you would think that this is an Indian real estate discussion. I had so many fun things to talk about on Indian real estate. But see, the Chinese overinvestment actually inflated the costs of many commodities. So I think that steel prices, iron ore is already at 88. And so if iron ore keeps falling, I think steel will keep falling. Aluminum, copper are not that big, but because of EVs and all that, maybe the demand will stay elevated. But steel, I think is likely to see a correction. Energy as well, given what the Chinese are doing, my sense is that energy prices, which is very important for cement pricing and all that, is also likely to be much better behaved than it was. So steel, see, I used to be a metals analyst, and I remember $650, $700 steel even 12 years back. And I think steel is more or less there still. And yeah, so that's my expectation. I don't think we will see Indian demand really boosting global commodity prices. We are not that big. On foreigners buying Indian real estate, what I'm seeing, see, I live the part of the community in Mumbai that I live, I mean, it's full of expats. So what we're also starting to see is just like there were Indian remittances, Indian workers sending, outbound remittances are now $6 to $8 billion a year. So there are more and more foreigners now living in India. So investment in Indian real estate by non-resident Indians, I think, will keep happening, is already happening, so I don't think that's a problem. But for foreigners to start buying, I won't be surprised that if in the next 3-5 years we see more and more of that happening. Because as we get more integrated, to get to the white Mughals type of stage, if you haven't read it, it's a fascinating book of the first century of British in India, how they adopted Indian customs, they bought property here and all that. That is some time away, but I do think that this will also pick up. with that, okay, so do I have time for another one? No? Okay, so I think, no, I would love to have my house delivered on time, so I'll keep this one on time as well. So thank you very much for it.
And what a fabulous, fabulous session this was. It was a literal masterclass in macroeconomics. This was just amazing, and I think his analysis has really provided us with great, great perspectives. And I'm sure all of you are going to be teeming with questions, but don't forget that we have an after party where you can totally grab him for, but such interesting questions as well. I have some of my own, so maybe I'm going to catch you. All right, ladies and gentlemen, a big hand to Mr. Mishra for this amazing, amazing session that has decoded all our questions. I would like to now request Mr. Anand Singhania and Mr. Pranav Pradhan from CREDAI to please come on stage to felicitate the wonderful Mr. Neelkanth Mishra. A round of applause, please.
Yeah, thank you, thank you.
Come on, we can do better than that.
I know. Thank you. Thank you for inviting me. Thank you. Thank you. Thank you. Thank you.
Thank you so much, gentlemen. And once again, thank you so much, Mr. Mishra, for this wonderful session.